Welcome back, everyone, to the Income Stacker. This is Randy Rodenhouse, your host for Mortgage Note Business Video Series. Today, we're going to talk about the typical returns you would see with a mortgage note. We're going to talk about a few different types of mortgage notes, institutional notes, private mortgage notes, and things of that nature. So let's get started. So first of all, we're going to talk about what I call institutional mortgages. What is that? These are notes that get originated from the big institutions like the Wells Fargo, the Bank of America, those types of institutions out there, and that generated a lot of notes in the past, a lot of the notes that became non-performing after the crash of the real estate market in 2008. And today we're going to talk about, again, kind of the types of notes in the discount market and what kind of return can you expect to get. So here we see a few different examples. First, performing. Okay, now performing notes, usually there's less than, when I say performing, these are notes that are performing for at least over 24 months. The default rate is very small, less than 1%. It's very high quality paper that was typically held by, money center banks such as Bank of America, Chase, JP Morgan, and stuff like that. And sometimes you can buy it at a small discount and then get a yield of 6, 7, it depends, 5, 6, 7, 8% return on your money. But usually those notes are, low yielding, for us anyways. It's low yielding. For the banks, it might be a little bit better. And they're buying those notes up if they can find them because, right now they're lending out at 4%. They would love to have a 6% note. So we're not really focusing in on those types of notes. Performing, yes, but performing with a lot more scratch and dent, let me say that. So let's take a look at the next category, which is reperforming. So what does that mean? So let's say a homeowner had a note, had a house, and stopped paying for a year, 2 years, 3 years, or something of that nature, and then we got them reperforming, and then the note could be sold off. Typically, the returns on those notes, once they're sold off, are anywhere from 8, 9, 10, 12% range. A lot of times we'll get reperforming notes at a higher percent range, but again, these are notes, this is kind of what you can expect if you buy a reperforming note, what you would have to expect in terms of a return. I'm not talking about the person that took the non-performing note and made it reperforming. Their returns could be a lot higher. We'll talk about that in a second. So these notes are defined as reperforming for 12 months or longer. They have good cash flow. There's a little bit of limited upside because the discount is not as big, right? But there's definitely good cash flow. And look, who's getting consistent, 10, double-digit returns? That's a great thing to get over long haul. Because typically when you buy a note, you have 20, 30 years of payments coming in. You don't have to worry about it, right? It comes in each and every month. So now let's take a look at subperforming. Subperforming notes. So these are notes that sometimes pay and then the person catches up and then they stop paying for a little bit and it's kind of back and forth, right? There's better equity here because we're buying at a bigger discount. There's good cash flow, but it requires a little bit more management, right? We have to manage the homeowner. We have to call them. We have to continue to bug them, to avoid them getting in default. So it's kind of, you have to babysit a little bit, right? Adult daycare. So those are notes you can get a little bit higher return, right? So we're usually expecting, 12, 13, 14, 15% returns on those, sometimes higher, right? We have ones that go up to 20%. But again, I'm trying to give you the, typical what to expect. And then non-performing notes. Non-performing notes, usually we're getting discounts anywhere from 35 to 50%. The non-performing notes are most widely available. There's a lot out there, and there's a lot of big upside, right? So I just put the potential returns from 15 to 50%. Usually, if we do the math on it ahead of time, if we don't get north of 15%, we're not even going to take it on. But we have many notes that we make a lot more than 50% even. In fact, I have one right now that we foreclosed, took it back, and now we're selling the house, and we'll make probably 70+% return. Again, it depends on how fast you do it, right? The quicker you do it, the higher your returns become. So bottom line is, if you get it reperforming though, usually, your returns are somewhere in the 15 to 20% once you get it reperforming, or sometimes higher. I mean, sometimes some of these notes you can really get a good return on. So again, a lot of intensive effort, a lot of management. It takes a little bit more skill to manage these types of notes, and you'd have to go through a process of learning to get to that point where you're buying these consistently. All right, so now let's kind of transition into what I call private mortgages. Private mortgages are essentially like seller carryback mortgages, private lending, hard money lending, things of that nature. I'm kind of lumping these all together. So let's just kind of break it out into seller carryback notes, what some people call it owner financing, same kind of thing, right? So really, what is it? What's seller carryback note? It's when a seller acts as the bank or lender and carries a mortgage on the subject property, right? So someone sells their house, they want to get full price, and they want to sell it, and they're willing to carry back some paper. They sell it to someone at a higher than normal interest rate than they get from a bank because they're taking some risk, and they get a note and mortgage secured on the property. Sometimes these can be first, sometimes it can be seconds, right? Depends on the rates. Again, I just put in 7 to 12%. Usually, what again, somebody could lend at 6%. I don't know, but I'm not going to look at that kind of paper. It really depends on the amount down, the note position, the person's credit, the loan to value. It's a big one. But a lot of times, you can buy these notes at a discount and get an even better return. So for example, if there was a note at $100,000 at 7%, and you got a discount on the note where you bought it at $80,000, so a 20% discount, your returns go up from 7 to 10. So you can get much better returns if you do that. There are some big players out there in this space, and they do very well because sometimes these people, what do? They pay it off, and your returns skyrocket. So early payoffs, your returns go way up, much higher than the 7 to 12%. You're talking 20, 30, 40, 50%. So again, that's what you're hoping. So some are going to do that, and that's how you can make some good money if you get a little bit of discount on the note. So that's another way to make money in this business. The other thing is private lending, hard money lending, fix and flip financing, fix to rent financing, buy to rent financing, refinancing and bridge financing. So all these types of things we do, and the rates usually are 12, 13, 14, 15% range, and plus there's typically points involved as well. Again, it depends on a few factors like the person they're lending to. Sometimes they lend to a rehabber. Does he have any experience, or she have any experience? What kind of money do they have to put down? A lot of different factors, just similar to the seller finance space, right? So these are just some ideas of, and gives you a ballpark idea what you can expect in returns. Usually returns are higher, if, you can get some discounts on the notes that you buy, like I said, in the seller finance space. But again, we do these things. We buy seller finance notes. So if you have a seller finance note to sell that you sold, let's say you sold a property and you want to, get all your money, you're tired of waiting for it, we'll buy that. Or if you are looking to do a fix and flip and need some money for that, or fix to rent, buy to rent, all those types of things, we will lend on depending on the situation, the state, and that type of thing. So with that being said, hopefully you enjoyed this video. Again, my name's Randy Rodenhouse. You can sign up on YouTube to catch all the videos there, or you can visit our website at incomestacker.com, and hope to see you on the next video.